Ellen, start first and foremost with us, your interpretation of the jobs number and where that leaves the Federal Reserve.
I think, people are looking at the number very carefully to see if what feds are doing is working, to see if what actions they've taken are loosening the labor market. There's incremental signs, but nothing for sure. And I think there is also some confusion in the market thinking that, only from the unemployment numbers, we will see a slowdown be more market. But in a high inflationary era, it is common that labor market stays tight before the shoe really drops. So I know this is a number that the Fed is concerned about, but we have way more to go before unemployment is threatening, where Fed has to reverse course.
We had, in the last trading day of the week, a big turnaround, as Caroline points out. Of course, a lot of asset managers are going to take risk off the table as they go into a Labor Day weekend. You don't want to be sitting on the beach worried about your portfolio. Sonal, Desai, you have a big portfolio to worry about. Is that what you guys have done at the end of the week? Do you see portfolio managers typically doing that?
So, Matt, I'd actually take it back to what you started discussing. The Fed lacks credibility. Markets don't believe that the Fed is going to do what the Fed keeps saying it's going to do. That's a problem for the Fed, and it's also a problem for markets. So we, in our portfolios, have actually, we started taking risk off sometime before this long weekend. We don't think that the long weekend in and of itself makes a major difference. I couldn't agree more with Ellen. This is one data point. The bottom line is I'm going to be looking very carefully at the Fed's new SEPs to see if we get some more realistic SEPs after the March and June projections, which I didn't think were internally consistent at all.
So I want to dig in there for a moment, Sonal, because you're saying they lack credibility. You are a bond money manager, first and foremost, fixed income. It felt as though the bond market sort of had interpreted the Federal Reserve along the right tracks prior to Jackson Hole. They didn't expect to pivot in quite the same way that the equity market did. Why do you think, therefore, credibility has been so hard to come about?
So actually, I'm not sure I fully agree with you, because we were at 347, the type of volatility we've seen in the bond market on every single data point, to me, indicates that the bond market also fully anticipates that the Fed is going to do what it's done for the better part of a couple of decades now, which is as soon as the market gets wobbly, the Fed blinks and it reverses course. It happened in 2018. People keep anticipating that the Fed's first and foremost view, the first target, the only target, is unemployment and growth. When we've got inflation at 8.5% and we have employment significantly lower than current NIRU, it seems remarkable because the Fed is beating one of its targets. It's knocking it out of the ballpark as far as unemployment is concerned. And it's completely blowing the other target and has been now.
By the way, NIRU, or NAIRU, the, what is it, non-accelerating inflation rate of unemployment. We got Larry Summers' take on that, which we're going to play out later. He says it's like 5.5%.
I would agree. Totally agree.
We're nowhere near that. But I want to get to something that I think is really interesting. And, Ellen, with your work into consumers, with your previous work in transportation and autos, I see this real divergence, or some of my favorite words now, bifurcation, dichotomy, in terms of the market doesn't seem to believe the Fed, but consumers seem to for sure, right? They're freaked out about getting low rates locked in on mortgages, getting a lower rate before they go and buy a car as those continue to climb higher and higher. How do you see the consumer right now, Ellen?
Well, consumer, I love that word bifurcation because I feel like it's the word for 2022. After what's happened after COVID, you see consumers, spending a lot on services, sort of a revenge spending, but also they are really taking back spending on discretionary. And, the goods side of consumer sentiment is really low. And you also see retailers already coming out saying they have bloated inventories. So consumers are waiting for deals. There's going to be negative earnings revisions on consumer discretionary stocks. And we're just waiting for the shoe to drop. And again, I agree with Sonal. The equity markets, the tear it went on in July and August, it clearly indicated that they believed that Fed wasn't going to blink. And I think this is why Jerome Powell had to use that strong language in the recent meeting to say, you know what, 8% inflation is not acceptable.
Sonal.
And you know what's really fascinating? That speech, Ellen, that he gave at Jackson Hole, it's a speech he should have given 6 months ago, right? I mean,
a year ago.
At the heart, a year ago. I've been crying for this for a couple of years now, because I really think that the delay is going to make this more painful.
Yeah.
And in part, it's because the Fed has to follow through. So I keep seeing everybody obsessed with, okay, today's jobs number, does that mean 75? Does it mean 50? Does it mean 75?
We're all macro tourists now.
It doesn't even matter, because the bottom line is, I think what I really need to see in the SEPs is internal consistency, potentially a higher peak Fed funds rate.
Remind us what the SEPs are, Sonal. These are the projections from the Fed.
Those are the projections, the economic projections, which the Fed does every quarter, which will come out again in September. And these are forecasts, median forecasts of all the FOMC members, including of GDP, unemployment, inflation, and importantly, you also see the median Fed funds rate.
Yeah.
Now, the ones which we saw from March and June had a Fed funds peaking at 3.8, I think, already in June, but this went together with unemployment, which remained at around 3.7 or 3.8.
Yeah.
And markets basically said, well, that isn't internally consistent. I think we actually are going to see, we need to see Fed funds above 4, and we need to see the Fed project a higher unemployment rate, lower GDP growth, and that somewhat sticky inflation to make this whole thing hang together. Does this make sense?
Still maybe trying to
that's what,
highlight a soft landing or the wish that was. Sonal, just very briefly, got about a minute left. Let's, in our first part of this conversation, you said perhaps there's more pain to come. Look, there has been evident pain in the market you look at first and foremost. I mean, Matt's been shining light on it all day. The ag index, the global bond market is now back in bear market territory. We've seen, as you mentioned, the volatility in the bond market. The MOVE index has been at such elevated levels versus the VIX. How much more painful can this get in your part of the market?
So I think that actually you're going to continue to see volatility until markets internalize what different central banks are going to do. Look, the exit from this quantity of QE and market distortion that we have seen over basically since the global financial crisis, so we're soon going to be coming up for 15 years, anybody who thought that the exit would be simple was dreaming, really. It was always going to be a complicated thing. And I think it's going to be extremely complicated. And the fact that we've got these issues with oil and commodities and supply chain bottlenecks, it just adds.
There's the global ag right there. You can see it on your Bloomberg by typing INGO, and it's down 20%.